All right. Good afternoon. Good evening. What's up, everyone? Welcome to Ask Me Anything, the Money Multiplier happy hour weekly, where we're going to answer all your questions. We got the Money Mentor team here. See if anybody else hops on. But if you guys are watching, put your questions over in the chat box. We'll get to all those here shortly. Big week this week for the country. New president, a lot going on in the world. So hopefully we got some good questions coming in today. We'll do some around the horn and introductions. Be right back in 14 seconds. All right. How's everybody doing today? Hopefully having a good one. Some good shows. Had What the F this morning. Had some fun talking about everything going on in the world today. Of course, Wealth Webinar. If anybody on Wealth Webinar today, we got into some Reg A funds, Reg D, the difference in private funds and how to use those along with the infinite banking concept. So get your questions in. We'll answer all those. And while we're waiting on the questions to just roll in, I'm Stephen Nagy down here in South Florida. Been representing the Money Multiplier and BYOB Money School since 2019. Been in financial education, especially real estate investing world, since I left the financial planning world back in 2008, where I was a personal financial advisor with Ameriprise Financial and traded the suit for, kind of some of the hip merch, right? You got the BYOB gear, the Money School hoodie going, and having some fun with it. Surrounding myself with amazing people like the Money Mentors we have on here today. So with that said, I'll pass it over to you, Mr. Brian Fouts.
Hey everybody, Brian Fouts here up in North Idaho. And it's kind of cool. I'm looking out my window and it's got blue sky and sun, which is rare for this time of year here, but still 2 feet of snow outside. And it's about 20 degrees. So I'm not going out there anytime soon, but it's kind of, I like what you said, Stephen, about how long you've been doing this stuff. So like I've been talking about infinite banking for about 9 years, really heavy into it, probably the last, 3 years to 5 years. But I've been, always learning though. That's one thing that, we as mentors, we're always learning as well, along with everybody else. And so and why I bring that up is I had a client that was told they could not do infinite banking. They were told by another group, not our group, but somebody else. And we just did a policy on her. I'm here this morning, actually. She was 74 years old, and it is an amazing policy, an incredible policy. So, if you're an infinite banking practitioner, always be learning, because what you know, what's the saying we always say? What's his name? Will Rogers, the quote right there.
Problem in America isn't what people don't know. It's what people think they know that just ain't so. And
on both sides of the table as well. So that was kind of interesting to do that. So it's got a lot of fun. So I'll pass it on to Carson.
What's up, everybody? Everyone throw your questions in the chat. We don't have anything from you guys yet. We do have some questions from last week we can talk about, but we'd love to hear what you guys want to know from us about infinite banking, real estate, anything. The football game's going on right now. We just had Ohio State winning the national championship. That's a big deal. We got NFL games this weekend. We got snow everywhere, which is crazy. So let us know what's going on where you're at and your questions for us. But this is Carson Herline. I got to pull out my new hat, BYOB. What's better, guys, mine or Steven's? The black.
I like the black one. I like the black one.
They're both nice. I think I like the black one.
I almost got the white, Steven. I like yours. But we got new merch out, everybody. So coming in today from Southern California, it is a nice 78 degrees today.
Oh, geez, I don't want to hear
it. Yeah, it's crazy. For some reason, a heat wave's coming through. We don't need right now with all the fires.
Yeah.
It's great over here. So passing it down over to Jason.
Thank you, Carson. Awesome to be here as always. I see this new guy, Chris Noggle, just popped in a moment ago too. But we, it's cold in Florida. It's actually cold. Like I watched one of the Money Mentors yesterday, or one of our peers, out in the Panhandle, pulling around his kid in a sled, bundled up for the winter, making snow angels, dog running around. I was like, this is wild. It's 35 degrees out right now. I just went in the plunge. I thought my trip was going to end today. I thought today was going to be it. I wasn't going to make it to day 66. But I was like 39 in, 35 out. It's almost the same thing, and it sucked. But I'm glad to be here. Get some questions, or we threaten we will talk the whole time, even without questions. Right?
That's a scary thing right there. Okay, get those questions in there. We do have one question. So this is from the 442nd, and it says, "How are commissions affected if loans are delayed for 1 year?"
I would say
They're not. Commissions are not tied into loans whatsoever.
Yeah, so we're not impacted by that, or the commissions are not impacted by that. So yeah.
Commissions are a component of. What'd you say, Stephen?
What loans are delayed a year? What does that mean?
I articulate it as 442 or 442nd is implying like if they didn't take a loan for the first year, how would that impact commissions? That's how I viewed it.
Yeah,
I thought too.
Be wrong.
Yeah, there's no difference. But this does bring up a question I was asked earlier today, kind of similar, kind of not. But he was like, "Hey, my policy set for $1,000 a month. I'm about to start this. I'm pumped, ready to go." But he said, "I want to drop it to $750 a month. And if I do that, how does that affect the policy?" And it made me think, well, there's no real effect. I mean, the dividends are the same. The percentage of cash value is the same. The proportion of a death benefit's the same. So there's no difference. It may be just how much you put in. That means you have less access to less money because you put less into it. But that doesn't mean you're better off or worse off because you're doing it. It just make more sense with your cash flow to do so. And so I get asked this question a lot of like, how is the policy better or worse with these type of premiums? And I think it comes back to what we all teach here of this is a process of banking. This is not a product you're buying. And I think we always like to hit that every episode because that's the biggest thing people need to understand. And the mindset shift that needs to happen is this is not a product, it's a process. And how the policy should be set up is based upon your cash flow. And so that was my feedback for him. Any other thoughts on that question?
I think that's good feedback.
It's awesome.
It's a great perspective that offers everyone listening, right, Carson? And some of what you're talking about, it really depends on where the person's at and their belief in this. It's like Henry Ford says, I probably say this on every call. You either think you can or you think you can. Either way, you're right.
Yeah.
And if you're right, and if you're on the call with us and I can hear that you're asking questions, well, how much do your commissions? I'm like, well, have you seen Chris's second most popular video? How you've lost $534,000? Oh yeah, I watched that. Like, why are you asking them?
Yeah.
Why are you asking? Like, you're still scared is the real answer, but you try to get them to tell you, right? So if their mindset's not there, then it's really about where do they start to prove that this works and do they believe in it? And then once they do that, they'll come back and do more. That's how it works.
Yeah. The mindset's a big one. That's been coming up a lot on the calls recently, but I had one individual who was hesitant to do infinite banking. It was all about the mindset. And he kept saying this, I know that my mindset is messed up. And then he'd repeat what was wrong with his mindset. And so I finally said, hey man, here's my suggestion as I've done mindset coaching before. Stop saying that. Stop saying that because every time you say that negative thing, you're reaffirming it in your mind. You've got to say the opposite because what you're saying is what you're focusing on. You got to focus on this. If you want to change your mindset, stop repeating those phrases. Go over here and start repeating the things that you want to believe in that are true. And
just have them listen to Earl Nightingale.
Yes, exactly.
That's what he needs to do, or he or she. You know, anybody that's got that issue, like just start listening to Earl Nightingale. That'll solve that problem right away. Or they're just going to have to acknowledge that, like, I'm just part of the 95%. I'm just going to conform to what everybody else is doing, and you know, we have to know who our client is not before we know, so we know who our client is. That's what I always say.
Yep.
Chris, but you're right, and the wild part about that, I was on a podcast earlier and the guy shared a stat with me. He's like less than, and this has come from Brian Tracy, another great thought leader. He said only 3% of people actually write down what their vision is, where they're trying to go. Mm-hmm. And then less than 3% of people are only looking. So it's even less than that 5%. So people in general, we're not aware. Like it's how we evolve, how we think. People aren't thinking about the future. It's how everything in the financial system is set up to how much can you afford on a monthly basis, not how much is it costing over a period of time.
Mm-hmm. Yeah, it's just like, when you talk about writing things down, I think we have an issue of overwriting things down. Like everything that we envision, we draw, or I draw out, and then we write it all down, and the entire team views it. I mean, it's just chicken scratch to someone, but this is the dream. This is the vision for everything that we're doing. And it's just like, nobody would understand that. But I look at this thing and literally in my mind, this is a masterpiece that just needs to take form. And then the taking form part is the hard part. But until it's written down, what it is you want or who you want to be, it will never happen. It can't. Yeah. Everything you dream in your mind, everything that you articulate in your mind can happen, but it's not like, oh, I thought of this idea and then boom, it's there. It's just like, you got to think about it every day, write it down every single day. I mean, you guys know, I wouldn't say it's every day, but almost every day. Like I'm putting in that mindset thing, I'm just reciting stuff that I listened to from Earl Nightingale or one of the books. And they're just positive affirmations. It's like, I need that. Like everybody's like, oh, why are you doing it? I need that. Like, I'm not doing that for anybody else. I need those positive affirmations. I need to make sure my mindset's positive because I know my mind, it's very easy to flip everybody's mind negative. And as soon as you go negative, bad things start happening. Things start falling apart. And that's just how it is. We don't understand it fully now, but someday, when we meet the maker, it's just boom, you're going to understand all of it. And you're going to be like, oh my God, it could not have been, is it really that it was that simple? And I missed it my entire life.
I like that. Yeah, one of the things I've done for people when I did coaching was it's called a life script, and the life script is it's like you have to build it out, but it's about 3 to 5 years down the road. But and there's a process to create this. I'm not going to get into it, but what I would do is have them create this life script using the certain methodology, and then it's about a page and a half. Then you would read it to yourself, then you'd record it in your own voice with some sort of background music a little bit. And then you can listen to that a couple times a day. And the life script is done in the present tense. So like you're actually at that destination and just hearing yourself speak about this is where I'm at. This is what it feels like. This is what I'm doing. It changes your subconscious over time. And that's really what it's all about. But that's one of the things that I've done. And then Bob Proctor is another good one to study on that kind of stuff when it comes to mindset. He's very good. I've gone through his stuff a couple times, his program, but definitely recommend Bob Proctor, that kind of stuff. But yeah, a lot of cool stuff you can do. Okay, so we got some questions coming in. Let's get some of these ones going. Let's see here. So Robert, he said, how and when are PUA additions calculated? If we received additional money to put into my daughter's policies and the policy's PUA limits allow us to input before the annual policy date, is it calculated by what is in the policy before the annual policy date, or is there a time calculation of how long it's been in the policy? I might have to reread that one.
I'm like on my second read through on it.
Yeah. So how are PUAs calculated? Well, so PUAs are calculated when the policy is structured and set up. That's the simplest answer. When you structure it and set it up, there they are. So whoever your agent is or mentor is can point those out to you. Now, if you receive additional monies to put into the policies and the PUA limit allows us to input it before the annual policy date is up, is it calculated on what is in the policy before the date?
You want to know what's interesting? I was talking to Mr. John Whipple at One America last week about this, and he taught me something I never knew. Maybe you guys know this already. But he said if the policy is designed up front and a part of the premium has term insurance to increase your MEC limit, then from day 1 of the year of the policy being set up to day 364 of the policy being set up, anytime in that first year, you can pay up to the MEC limit and it's the exact same amount of PUAs. There's day 1 and the end of the year. But if there's no term on the policy, then it's based on how much base you put in and how much dividends you've collected throughout the year, and it changes and increases over the year. Mm-hmm. Does that make sense?
Yeah. And he did the same thing for me on a policy here yesterday. Yeah.
So that might be a factor if there's term or not. If there is term, then it's a set PUA for the whole year, and that's all you can do.
Yeah. And Carson, that's interesting because we talk about it here, and I'm always learning. Like we talked about at the beginning, always learn. Don't have your ego there. Ask questions. Like I know I've asked questions when Chris is just like, simple, man. I thought you knew this. Like, no, dude, like if I don't know, I'm going to ask, right? Just to be fun. But like if I believe that your mech limit moves. That's why like you can't go to Jonathan, who's been doing it for 15 years or 17 years, and have him say, hey man, run this. You have to actually go and take it to the actuarial department and say, hey, run these numbers, and because that mech's moving, because your death benefit's always increasing, your cash value is always increasing. And that's my understanding. Now there's probably a nuance there that I don't yet understand. But I just have people, depending on the company, just go ask the company, how much additional paid up additions can I put into this policy? And either ask it on a regular basis, ask it quarterly, ask it annually. Like whenever you have that money, Robert, just ask. And if you can't fit the money into that container, guess what? You need a bigger container. It's time to expand your system.
Yeah. And it's also company dependent too. Every company is slightly different on how the policies can be built for PUAs year 1 versus year 2 versus year 3. It depends. And so how your policy is built is going to depend upon that, or going to impact that. But bottom line, if you have $10,000 of PUAs you can put in that given year, you put in 4, you have $6,000 more you can put in. And that's going to reset at the start of the next policy anniversary. That's kind of a general answer right there. Yeah. And yeah, depends on how it's been structured.
Yeah.
Let's see here.
Shane's got a good question. Oh, you're not that far down yet. Okay.
Not yet, no. Cindy, so can people purchase a home with a first lien HELOC at the beginning?
Yeah,
you can.
Yes, we can.
You got to qualify just like anything else with a bank. You got to qualify first, but they are a little more stringent on the first lien HELOCs when it comes to debt to income ratios and your credit score. But you can purchase a home, as I understand it, up to 90% of the value with a first lien HELOC. So, yeah, you can.
I love up there, Mark. I think it was Mark, right? Mark Perry, about Denzel Washington.
Yeah.
That's another one of those motivational things. Denzel Washington's motivational videos are super good to course correct your mindset. Sorry, I just wanted to call that out.
Yeah, well, you're right. They're good. I haven't listened to them in a while, but I used
love
to
them.
Love
them.
I'll look it up right now. Yeah.
He's awesome. Like the man. And then you go watch him in his, what are the 3 movies he have? They're super violent when he's always coming back to take care of things. I think Equalizer. Go watch Equalizer 1, 2, and 3. Great movies. But then you go watch him like being very, very. He's very deep. You can tell he's very spiritual, right, Chris? He's very spiritual. He's moving. And then it's Denzel. He's just cool. Like you want to hear him say stuff.
Yeah, it's pretty good. Evelyn's had a question here. Says, "Thank you for your time. Can you discuss how to get started as far as the policy amount? Is it possible to fund a policy up front? Can a policy be used as you will use money market to pay down debt?"
Yeah, for sure. The policy amount is really just how much you want to save. And you could do the 2 components. You could, maybe some people, a lot of our clients have a chunk of money that they dump in. That money might have been sitting in a bank account, a money market, just emergency fund money. They dump it in there so that it's earning a better return, tax-free, and has all the protections. The second component is how much do you want to save ongoing? And that could be monthly, quarterly, semi-annually, or annually. So you pick those amounts, okay? Not us. And then we build the model around your savings ability or your savings plan. And that's how we would do that. So and then you mentioned, can a policy be used as you would use a money market to pay down debt? Exactly. But the biggest difference between like a money market or a bank account versus this is your money never loses the ability to earn, because it's always going to be compounding uninterrupted. Where a bank account or a money market, if you save up in a money market, you might be getting a decent return today of like 4%, which might be this, similar to what you're getting in the policies. Policies are a little more, but when you take the money out of the money market to pay the debt down, all of the money you took out of the money market stops working for you. It stops earning. The policy never stops earning. So that's why the policy is definitely a much better mechanism to use for, today we did it for investing in a private fund. So we were starting to run the mathematics on all of this, but that we've had figured out for a long time. So if you're trying to pay down debt, this is definitely a more optimum way to do it.
Okay. Okay, so this is from the first question. So the 442nd.
Pause there for a second, because it's such a good answer Chris gave. But it's one that I feel like I get asked this question, or people come in and they really know what they want to do, and then you ask them like, well, what would you want to make your premium deposits or pay yourself over the next 10 years? Like, I know we're talking about today's problem, but what are we looking like? How much are you saving monthly? How much are you saving annually? How do you guys direct people on that when you're walking them through that the simplest way possible? Just curious. Like, how do you help people decide, like, what is that number for me? Right.
Yeah. I just ask them, I mean, how much are you saving today? Most people have a defined savings plan. If they don't, I say, okay, a lot of people put money in a 401k, and I'll just say, okay, how much is the match? And they say, okay, the match is 4% dollar for dollar. Okay. How much are you putting in? Well, I'm putting 15% in. I said, okay, let's back that down and go down to the match, because we want to at least get that free money the company's going to give you in the match. So now we've just created this, money that now is in your paycheck that wasn't there before because you were saving it in a 401k. That money then could be used for things like paying down debt, which you're not making the same returns in your 401k as you're paying out on your debts. I don't think I know anybody that their debts have a lower interest rate than what they're earning in their 401k. So that's the one way. And then on top of that, I ask, okay, so when Christmas is coming around, do you have a program for buying gifts, like, a Christmas club savings, or, do you have a 529 college savings plan? Like, where are you saving money? What are your compartments? And then I just say, okay, what is the goal of saving money here? Great. What if that could be done more efficiently here? Would you change where that goes? And I just, that's how I go through that methodology of figuring out how much somebody is saving. And I never want to put them in a place where they commit to a savings amount that's going to stretch them. So 2 ways to do that. Maybe they want to be stretched. Then I will build lots of flexibility on the downside. So somebody says, hey, I think I can save $1,000, and a keyword, think. I think I can do 1,000 a month. Okay. What do you mean you think? Well, yeah, if this, okay, great. But if I can't, would you be able to go down and do, $200 or $300 a month? Would that be a good, acceptable minimum? And then we'll just build that flexibility into the plan.
Yeah, and that's part of how I do it too. But like I'll get a question like this a lot, or a response, and I'll say, hey, what are you thinking you'd like to put towards infinite banking? What are you thinking? I don't know. I need you to tell me. And this is when I get that quite a bit. I'll be very clear. I says, I don't know your budget. I don't know your expenses, and I do not know your money mindset or money habits. I can't tell you that, but let's walk through your situation and start to unpack it a little bit. And then I start asking what's called leading questions to get them thinking, because if they don't know their money habits or their way they handle money, then I can't build a policy that is a good fit for them, right? It can be dangerous. So, yeah. So that's kind of how it works on that one, is that I ask them leading questions.
I think it's just good for people to hear the different approaches to these questions, because people do come in knowing what they want to solve right now. Like, hey, I'm going to buy this car. I have this much money. But they don't think, what am I saving annually? Where is that money going? There's all these components. So it's good to hear you guys breaking it down different ways. I think it's
nice hat, Joe.
Hey, Joe.
I thank you.
Word
especially for today.
There we go. All right. Let's see. So this is the follow-up question or a response, but 442nd said, I'm in the process of being licensed. The person who recruited me is driving around in a 500K Ferrari. He's selling IULs like hotcakes.
Oh, I got a lot to say here. So just give me the mic for a little bit. So let me just go back in time. So I'm going to talk to you about my first interview when I was applying to be a financial advisor. This is going back to, this had been 2002 by the date. So I'm dating myself. I sat down in a conference room, dark, dimly lit conference room at this financial firm. And, everybody that I talked to when I came in there was pretty pricky, kind of didn't really say much. The guy comes in and he's telling me all about the firm and, all the people, that are there and how they're crushing it and how much money they're making. And then if you've ever seen the movie Boiler Room, he pulls that one out. Now, at that point in time, I had not watched Boiler Room. So this was fresh to me. He literally says, if you work for this firm and you put in the amount of work you put into your businesses, because he knew I had, businesses at that time, you will have one of these. And he throws his keys on the table and slides them down. I can't remember what kind of car it was, either a Lambo or a Porsche. And all I remember thinking is, holy shit, I can have that car if I work for this firm. So I took the job, ended up hating it, switched firms like within the first month and a half and went to another firm. But if you're getting licensed for the sole reason of you want to make $500,000 or you want to own a Ferrari and you're going to do whatever it takes to earn that Ferrari, including selling IULs, please stop trying to get a license. And I don't mean to be rude about that. If your sole goal is to go out there and sell the product that pays you the biggest commission, IULs, so that you can have a fancy car, that only can happen if you are hurting somebody else. And I don't mean hurting is the wrong word, but you can't have if somebody else, it's always, somebody's got to give for somebody else to get. So this guy, this company that recruited you sounds a lot like the guy that recruited me into that firm, that he's flexing the $500,000 Ferrari. Maybe he is, maybe he isn't, and selling IULs. IULs are the highest commission product. You know why? Because the client is the one paying the high commission, which means the client is the one getting the short end of the stick so that you can get the big end of the commission. Now, if that's okay within your ethics, perfect. Carry on. And you know what? You'll be out of the business in 2 years. Mark my words. If you make it to 3, I'd be really surprised. You will be out of the business because you will never make it in this business. I've been doing this 21 years and I'm giving you honest to God, good advice. You will never make it in this business if you put yourself in front of the client. Never, ever, ever. And that guy selling IULs puts himself in front of the client. Not to, we could go around. I could ask everybody what they're driving. I mean, I already know what everybody here is driving, but they're all driving really, really nice vehicles because we all do really well. But we all do really well taking a commission. You had mentioned earlier about the $534,000 because of the way we design these policies. We literally cut our commissions anywhere between 60 and 90%. But yet, because we cut our commissions by 60 to 90%, we have thousands and thousands and thousands more clients than that guy driving the Ferrari. Thousands more clients, guaranteed. Okay, I would tell you we probably 10x what his ass is putting in every single month for policies. He's driving a Ferrari because he's making more per policy. We're solving more people's problems, which which one would you prefer? Would you prefer to solve more people's problems or less people's problems so that you make more? I got 5 Porsches in the back garages, okay? 5 of them. And I earned all of them by doing what's right for the client. So nobody can tell me it can't be done, but it does take time. It takes a big commitment and it takes you giving so that somebody else can get. That's all I have to say about that.
Perfect.
It's true.
Yep. All right, let's move on here. So Shane has a question here. Curious if converting a term policy to whole life has similar income requirements. So I'm not quite sure if you're referring to the qualification of the term versus a whole life.
If you look at Shane's next question, he gives us a little bit more context.
If you make $100K annually and you're maxed out for insurance on yourself, then can the term still be converted?
Yeah, I actually, that's a great question. And
Yeah,
I want to confirm that, but I think you can, Shane, because you've already got the coverage in place in the term. So the death benefit's already been underwritten. So converting that to, a whole life or, which is, I assume what you'd be talking about doing I don't believe would not trigger that income threshold or that human life value threshold because you've already got that coverage and all you can convert is up to the death benefit that you have in term. So if anyone else knows different than me, please comment because I think that's a phenomenal question. I've never heard that.
I mean, it seems pretty simple, right? Straightforward. If he has that death benefit, he's already carrying it on his body. It's not giving him additional death benefit, so it shouldn't change anything.
Correct.
Now, it'll change into whole life, which will be helpful, right, Shane? Because it's not going to end. The term is not going to end. So
I was going through the underwriting requirements, and you can do that. Yeah.
It can't be just any term, though. It needs to be a convertible term from day one.
Correct. You have to qualify for the conversion. But yeah, I was going through the financial requirements on it for a client, and they said you can convert it over without they don't have to qualify on the death benefit side. You have to qualify on the obviously income side for the premiums. But yeah, they said the death benefit side, you don't have to requalify for that side of it.
But not all convertible terms would be able to be put into banking policies either. So it depends on the company, I think.
Yeah.
Are all convertible terms able to be converted to an IUL or a VUL?
No, the convertibility is really something you have to buy a term with there's only certain term products out there that have that convertible option. Not all do.
And even then, even if they are convertible, it doesn't mean they can't be converted. You still got to qualify.
That's a good point. That's a very good point.
Yeah, it's not. And the only reason why you convert it is if you don't think you can get insured for that same amount on a whole life policy. That's really the only reason why. I've had a lot of clients that say, "Oh, I want to convert it." I'm like, "Are you healthy?" "Oh yeah, absolutely." Then you don't need to convert it. It doesn't make any sense. So yeah, good question. I like that one.
You would just be moving the death benefit from one policy to the other, still giving you access.
Yep. All right. So this is Robert. He follow-up one says, "Thank you for the previous question." He asked, "Is it allowed? Just curious if it would be beneficial to put it in before the anniversary date or when the next deposit is due." He's talking about the PUA portion. It really depends on the structure of the policy and how much you're trying to put in versus what would be allowed in the following anniversary year or policy year. It just depends.
Let's talk about what PUAs do really quick for Robert, right? Like when you look at the illustrations, it kind of tells you right on the illustration what the PUAs do. Like if you think of this being your death benefit cup, right? And if you look at the end of the contract, whether it's an older contract at 100 years or one now where it's 121 years, that's when your cash value equals your death benefit. So when you get a PUA, it is a carbon copy of your, as close as possible as your original contract. That's what your that's how we structure dividends to buy more paid up additions. So when you get a paid up addition, it has to buy something. It buys more death benefit. And if the death benefit goes up, I just told you at the end, the cash value has to equal it. What has to happen? The cash value goes up. Brian likes my cups. He's smiling. So you get the cash value going up, and that's going to give you more dividends. So the sooner that you're able to get the PUAs into the policy, if it can hold it, the faster that cycle of growth, guaranteed death benefit, guaranteed cash increase, guaranteed dividend, well, not guaranteed, but dividends going up are going to happen. So it's just checking with that carrier, whoever your policy is with, Robert, and seeing when you can fit it in, and getting them in as soon as possible is a good thing. So,
yeah. By the way, Chris, Vivi wants to see cash.
I love that. That's going to be the highlight of the show right there.
Yeah. Vivi wants to see cash.
Yeah. I think Cash is hunting. Is Cash
I'm
around?
literally texting Larissa right now.
That's funny. All right. So let's get some questions. Let's see here. Margaret says, "Is there a maximum dollar amount on a first lien HELOC?"
That's a Joe question.
85% LTV.
Is there a maximum loan that they'll give out on a home? Like 2 million, 5 million, 10 million?
Oh, on that number? Hold on. There is.
Everybody thought Joe looked different because of his smart hat he's got on, but it's the glasses. I was like, what looks different about Joe? He looks smart today.
I can see.
By the way, really good book. If you guys ever are needing something to read, definitely check this one out.
$1.5 million max on a $2.14 million house, it looks like.
So you are limited. And so 85% of the purchase price not purchase price, but value.
That would be 70. So there's different grids. If it goes up to 588,000, we can go up to 85% LTV. If the house is worth between 625 and 937, it goes up to an 80% LTV. If it's from 937 to 1.7 million, then it's like 750. So there's like a grid as you kind of go. But like at a 2.14 million and higher house, that would be a $1.5 million max. But call me up, email me, and we can have a strategy call and go through your numbers.
There we go. All right. Judy has a good question here. Is there a difference between a larger deposit or depositing more monthly?
Yes.
Yeah, absolutely.
Big time.
Yeah.
Yeah. The dump in that you put in really, it's just like supercharges the policy's growth because you have all that money immediately earning interest and dividends and compounding right out of the hole. Where if you're depositing monthly, like the one I showed today in Wealth Webinar, that policy that I started in 2020, like I started that funding it monthly, and it was just a slow grow because you got 1/12 of your money every single month earning interest and dividends. So it literally just pushes back that compounding effect where when you dump money in on top of systematically, saving money, now you've got all that money immediately earning interest and dividends. And if you've ever seen any of the YouTube videos I do or the wealth webinar videos where we show the dump-ins, like those policies, like they literally just the rockets, and then you look at one where it's just like systematic funding, like we do in our 90-minute video, like the car one or the chiropractor, where it was just a flat funding. Like you could see like that efficiency point was pushed back. It took longer for the policy to hit its efficiency.
And also it affects the death benefit too.
Yeah, good point. Yes.
Generational wealth.
Big time.
So I had a client yesterday who could have done like their small premium, larger deposit, but they said, no, I want to have a higher death benefit down the road. And so higher premiums made more sense for that person on the annual basis because they got a significantly higher death benefit. And that's exactly what they were trying to do, as well as the banking. So it depends on what you're trying to accomplish as well.
Yeah, there's always a trade-off, right? People get shocked when they look at year 8 or year 11 when their death benefit drops off when they do a giant dump in. It's like, why does it drop off that much? It's like, well, the other way to do it would be to build more flexibility, like Chris was saying earlier, to the base, right? Like have the base be a little bit smaller so you have that flexibility and put more of it in. That way it's growing every year. That's what we're trying to say. That way your death benefit goes like this.
Yep.
Forever.
All right, let's go to this one here. Knights of Israel says, so probably a dumb question, but there are no dumb questions. But I heard that you don't have to pay off your loans you take from the policy, but I also heard that some policies can collapse if you don't repay your loans. Why is that? And then his follow-up question is, is it because of the loan rates? It's because of if you don't pay off a loan, then the loan compounds negatively, the negative direction. Because if you don't pay the loan off, the interest is on top of the loan, but next year, then you're going to accrue interest on top of that previous interest and the loan balance. So if it grows too fast in the negative direction and your policy is not growing the cash value fast enough, you can lapse a policy because all of a sudden your loan is more than your cash value.
It takes time for that to happen. And
long time.
It definitely happens faster. Like that lapsing would happen faster in a regular whole life or like an IUL than it would in the ones we designed because they're so top heavy on cash value.
Yeah. I mapped this out for somebody because they had a loan from a policy from a previous company agency, and they had taken loans out not knowing how they worked, which blew me away. And so I went through and mapped it out for them. And if they didn't pay the loan back, their policy would take like 50 years for it to lapse. 50 years.
Like when I did Vivi Lucky Jeans, like we showed that taking loans for all those different scenarios and throughout her life, and we never paid the loans back, and her policy never lapsed. So it really is just more of a component of age and how the policy is designed and lots of things. But at the end of the day, like if you're asking that question, the most important thing you need to know, Knights of Israel, is be an honest banker. You don't have to pay the loans don't have to get paid back. Like, as a matter of fact, the name of the game in the infinite banking world is to keep your money out there working. Always keep your money going around and around and around. But the number one most important thing that people somehow seem to forget is when money goes out, you always want that money working for you, earning some type of an interest rate or a return or paying off a debt that then creates cash flow. And all that money must be recaptured back into the policy. That's that part of that circle. Like, when you think of infinite, right, it's a connecting loop. If you break the connection, it's no longer infinite. So if you're creating a banking system and you just start stealing from your bank, which is the same as not paying your loans back, if you owned a traditional bank and you went in, you took a loan and you're just like, I own the bank, I'm not going to pay the loan back. And you just kept doing that, your bank's going to go out of business. Your bank's going to be defunct, like no matter what. So if you borrowed from your bank, you walked in, you took a loan from your bank, and it had monthly payments of $500, and you paid your bank back $500 every single month because that's what you committed to doing every month. When you made that $500 payment, if you owned the bank, how much money is back in your bank? $500. So why would you not make that payment back to your bank? So that's the thing. Be an honest banker. Never steal the peas.
And so this is in response to your IUL response. Wow, it's like God took me here. So good answer there, Chris.
Oh, there's a lot more I could have said on that. But
Hey, I believe that's actually really true. Like, I didn't know all you guys. Like, I didn't join the Money Multiplier to, mid 21, right? So it hasn't been that long. I didn't know Fouts or Carson or anybody here, but we're all here because we were asking similar questions, looking for similar solutions, and now we're here with a huge community. So it's not an accident, 442.
Exactly.
I was the biggest pain in the ass. That's why I'm here.
You were?
Imagine that. Imagine
Yeah,
that.
he was one of the biggest.
He still is. He was.
Just a different way now.
Yeah, exactly. But in a great way.
So I'm trying to understand this question here. It's from Jeremy. It says, your videos on debt payoff examples say, year one, take a loan, and the monthly payments now goes to your bank account. Year two, second loan plus savings in bank are used for debt. Is there no repayment? So this is a good question. So
talking about the chiropractor example.
Yeah.
So the first year puts in 25, takes 14 out, pays his debts, recaptures the money into the segregated bank account, which is where it stays. So there is no loan repayment. So the simplest answer here is yes. During that 6.5 year cycle where the chiropractor is putting money in, taking money out, and paying debts off, zero loan repayments are ever being made back to the policy. The chiropractor, I didn't build it into that model because it just adds another level of complexity, and we're trying to just show the process. The chiropractor was paying the loan or the interest on those loans above and beyond the $25,000 he was putting in. So there was an additional payment that chiropractor was making for the interest on those loans over the course of that time, which it wasn't a lot of money, because if you remember how much he was taking in loans, by the third year was 55 grand. So back then, when that policy was done, loan interest rates were 4%. So he was paying 4% on 55 grand. That was out of pocket. Okay. Because he wanted to pay the debts off. That was his goal. But what I don't do a good job of explaining in that video, I do it. And if you watch the new one, I do, when he paid all of his debts off. So he no longer owed any other bank. Remember, he had about 5,700 and change.
5777.
5777 going back into his bank account, that segregated account. At that point, when all of his debts were paid off, what he would have done and what he did is he flipped that 5777, and now that became a loan repayment. He set up an automated loan repayment. And if you did the math on, that's 60 some $1,000, it would not take him long to repay all that money back into his policy. But he didn't pay any of the loan back in the first 6.5 years. So good observation. But after that 6.5 year, when all that was paid off, he just redirected that newfound money that was going into the segregated back into the policy. Because why would you leave that money in a bank account where they're using your money versus putting it back into the policy? And remember, here's the coolest part. When you're repaying the loan to the policy, every repayment back is money you have to use the next day. This I know is a part that your mind just can't comprehend that, because you think of a loan repayment as money's gone from your family forever. But when you own the bank, the loan repayments you're making go back into your bank, which means it's your money, it's your bank. So you get to use that money again. And that's the most important thing for a lot of people to realize is, and if people just grasp that, they would no longer have an issue with, I don't want to pay back. I don't want to pay I don't want to make payments back to the policy. That's stupid. Like, it's my money, blah, blah, blah. No shit, it's your money. So put your money back in there, and you're guaranteed to make whatever the loan interest rate is, which call it 5.5% right now.
Yeah. It's a line of credit. Of credit. Just
it
you
is.
have to think
Same
of it
damn thing.
as that.
Now, I had a question from a client here recently, and I want to put it to the group here and see what your response will be. It's in the same lines here. They're saying if I'm doing annual premiums and I'm going to take a loan out every year to do debt, and I'm putting the debts that I paid off into my segregated account, why wouldn't I take that money and put it in the policy loan?
I do. I do. It's just that video just doesn't show it being done that way. You have to sometimes understand, when you're doing a video for the mass public, it's got to be simple. Now, just imagine the simplistic nature of what we show in that chiropractor example. But then just imagine if I added a step, which I personally do, and I always tell people to do, of now taking it from the segregated account back into the policy. People now all of a sudden forget that extra step confuses them, because Brent used to show it that way. And then he's just like, people just it's too much. So yes, there is no reason that money should have ever sat in that segregated account. It should automatically, when it hits the segregated, how I do it, let's say I set up a bill pay. I'll use a car payment. I got the car payment. I got the note. I set up a bill pay into the segregated account. Okay. So my main bank account pays the segregated account X amount of dollars. Then I set up a loan repayment form, which is a piece of paper you fill out for that exact dollar amount. And I have it swept out of that account like a week later. So you kind of allow a little extra time for holidays and that. Now you've created that loop, and now you're earning the equivalent of whatever your loan interest rate is. Again, average 5.5% on that money that was just sitting in a bank. And there ain't no way in hell you're making 5.5% in any bank in this country right now.
Yep. Exactly.
It's a great question.
All right. Yeah. Real quick. So J10 had a follow-up question for the HELOC. Would you need to pay off all debts as part of the app when trying to get a first lien HELOC?
No. What happens is we'll do a debt consolidation. We'll take your house value, 85%, and then the equity we'll use to consolidate your debts. We'll pay off the car. We'll pay off the credit cards, the student loans. We'll incorporate that inside the HELOC as the nucleus, as the one part, and then that's how they qualify you. So most banks, if you go to them, they will do your DTI, your debt to income ratio, before doing the HELOC. That's why some people wouldn't qualify. When we qualify you, it's the 85% number that we qualify you on after the debt consolidation has already taken place.
Yep. All right. So Christian said, hey, everybody. If I pay monthly and end up having extra money at the end of the year, can I dump it in if I'm in my first year, or better off opening another branch? It depends.
Yeah. Chris, I know, I'm pretty certain you got your policies with One America, so you just have to go and ask, like, how much policy services, how much additional PUA can I put into this policy in this month without it becoming a mech, and they'll tell you. And that'll guide you back. I believe, isn't it you, Carson? That's Christian's?
Yep.
Yeah. And Christian, I know you well too. So just, reach out to Carson. He'll help you figure that out, or he can give you the question you got to ask, and then you'll know the answer. Pretty easy.
There you go. So James, afternoon, gentlemen. Putting policies in place for me and Riza. How long is my medical good for if I wanted to try and get a key man policy in place with a restaurant partner? 6 to 12 months in most cases, but it's actually a case-by-case basis. No longer than 12 months has been the answer I've been given. Before that, it's up to the actual underwriter and your situation and all that kind of stuff. But usually 6 to 12 months is what I've heard. I don't know, anybody else know?
Yeah, that's all right.
Yeah, I knew that they stopped the 12, so.
Yeah. So 12 is a simple answer, but it depends. Let's see here. Shane has another question here. When would one want to look at a COLI policy? Corporate-owned life insurance is what you're referring to. 2 managers, executives on one company, LLC. Would it need to be an S corp?
It's an easy one. Doesn't need to be an S corp.
LLC.
When your company has money sitting in bank accounts that you don't want to take out because you don't want to be taxed on it, like you don't want to take a distribution, you want to take a salary of that, and that money's just sitting on the books there, that's when you start using COLI. In my opinion, that's like the trigger. So you got excess money in the company and you got executives, you got to have bodies to insure, but you could just be the sole key person of the company. And I always tell people the difference between a personal and a COLI is, like, the company has money just sitting there. If you take that money out, you're going to trigger taxes because the distribution or, salary or whatever. So by keeping it in the company and having it go into the policy, it allows that money to work a little bit harder for you in the company. And the death benefit is very important for COLI policies because it provides that legacy for the company, because the company will outlive all of us. A company will live on.
Yep. See, Terry had a question here. Did you ever find a company that would give you a first lien HELOC on an investment property? Is that CMG?
Yes, CMG does do it. I do not have a contact person there yet, but I'm working on it.
Gotcha. This is another interesting one. So this is the number 442nd again. Any opinions on marketing annuities?
Yeah, I mean, if fixed annuities, we use a lot of fixed annuities. I don't really talk about it enough, but I think they're a great fit for the right use. I almost think the better marketing option is take one from Fisher Investments and market against annuities, like variable annuities specifically. Like they built an empire marketing against people that have variable annuities. And I interviewed with this company, so I got very familiar with them with my due diligence, and they do a phenomenal job. They do one thing, which is assets under management, and they go after only one client, and that is a client that bought a variable annuity. And now what they're trying to do is just say, get out of the annuity. They're terrible. but they're referring to variable annuities, and move it over into, AUM, where there's no surrender charges, no, mortality expense charges and all those things. But fixed annuities have a good place in the market.
Yeah, so if you went with the guy with the Ferrari, you could just go after all the clients that bought an IUL and help
That
them.
that guy that owns the Ferrari is selling variable universal life.
Well, no, that's what I'm saying.
Variable annuities only.
He could go like follow the client and then go, hey, let me help you get into something that you actually are in control of versus the insurance company.
Better yet, he's probably selling IULs and indexed fixed annuities. Not saying there's anything wrong with indexed fixed annuities, but yeah. Anyway, we'll just move on.
Yeah. It's fun to get you fired up for a moment, bro. That's all.
So follow up to the Coley question, corporate owned life insurance. James said, if you ever transfer the policy ownership from the company to you personally, is it taxable event to you? Depends on how it's set up in the first place. So I don't know. This is an attorney question, not financial advice. But if you set it up through an entity with an agreement between you and the entity, it can be funded potentially with pre-tax dollars. And so the premiums can be a tax deduction essentially. And so if you transfer it out of that scenario, I don't know, would it be taxable? I don't know the answer to that one actually.
Is James saying it as a matter of fact, it is a taxable event?
He's questioning if it's going to be a taxable event to you if you receive ownership of the policy when it was originally owned by an LLC or an entity.
Yeah, no, it is. That's what he's saying. Jimmy's smart.
Oh, he's saying it is right there. Okay.
Yeah, so.
Yeah, I asked a similar question, but it wasn't in the same vein. But they said it depends on how it was originally structured and how it was paid and the tax implications at the beginning. So, because Coley can have tax benefits. So I think what he's saying is if you transfer it out of that, then yeah, it would be. That makes sense.
Yeah.
Makes sense. Question for you, Joe. Is the first lien HELOC monthly payment interest only or part principal?
Interest only.
Yeah. And we always pay principal plus interest on those when you're doing like velocity bank and that kind of stuff.
Well, you're just paying the bank the interest. So then everything that you leave in technically goes to the principal. For the last 6 years, I was actually doing principal and interest when I was paying my HELOC, which was actually stupid because they were, let's say out of $1,000, 500 is going to interest, 500 is going to principal. I had to input $1,000 to them, and they just took 500 and put it right back in to my HELOC that I could take out the next day. So, I mean, it's kind of stupid the way they do that, but
yeah.
Interest only works.
I guess it forces people to pay more on the principal.
Yeah, not if I take it out the next day, though.
Right.
Yeah.
That's just 2 trips that I got to do, or twice I have to open my computer.
It wouldn't work for velocity bankers, but it would work for someone who has no idea what they're doing.
Yeah.
There you go.
Well,
there you go. All right. We got 30 seconds. If you don't, it says Jeremy. So if you don't repay first loan and pay in second premium, you have access to full first and second year cash value and not affected by previous loans.
You'd be affected.
Yeah, all the loans. If you take a one loan and take a second one, it just adds to the loan. It's not like it just adds to the loan balance is all it's doing. So yeah, it does affect the cash value.
Yeah.
Until you repay the cash value, you can't recollateralize the money or borrow against the money.
You just don't have the collateral.
I get this question a bunch where someone's like, if I took out the whole cash value as a loan and I don't pay it back, can I take it out again the next year? It's like, no, not until you add more back in.
Yeah.
You have to refill that bucket.
Yeah.
So if you deposited 10,000 and in the first year you took out 7 within 30 days, the next year you're going to put in 10,000 and then you're going to be able to take out 7,500 to use again. It's not 14, it would be the 7 because you already took out the previous 7. Just think of it as a line of credit. If you were to pay back 4,000 in the first year and then you inputted the 10,000, well, now you're able to take out, say, 11,000, 7 plus the 4. Just a line of credit. The more you put in, the more you can use.
Yep.
And Dremmy's asking great questions. So Snaggy, if you could drop the link for the mentors to schedule a call, because I mean, these are these are pretty exceptional thinking through this question. Like the first question, this question, he's definitely someone who's studying. So
for sure.
Or she, I'm not sure. So
yep. But a couple last minute questions here. Whoops. Where'd it go? Here we go. Shane says, what if a trust is the beneficiary for the COLI? Well, you could make the beneficiary whomever you want. So, and then James has a follow-up answer to that. His question is, does the trust own the business? So it depends on, this is where an attorney would be very recommended to go through and structure this correctly, based upon the wishes of the company and the owners of the company. That would be my.
Yeah, it's more the agreement. There has to be an agreement written up about the COLI policy with the company. And so it'll state in there who the beneficiary is, how that gets changed, things of that nature.
Yeah. And Shane, as far as should the trust own the business? Once again, that's going to be up to, the owners and, what you're trying to do, why you'd want to trust, because a trust is for probate protection, not really for asset protection. And it's for privacy. So, but that's once again, that's more of an attorney question and structuring it based upon how you want the business to operate, to be honest. And then Jeremy said, barely started to dip my toes into the process. Well, awesome. So glad to have you on the camera. Yep. So guys, that's it. That's the last of the questions right there.
2 minutes.
We did
over,
it again. Celebrate.
Yeah. That was a good one. A lot of great questions. Great questions. All right, folks. Well, thanks for joining us for another episode of Ask Me Anything Happy Hour. And if any of you are out in Colorado, happen to be at X Games, hit us up. Me, Steven, Shauna, and the crew are going to be out there. So let's take some runs. With that being said, we'll see everybody later.
Ciao.